It was a Thursday afternoon, and everything looked perfect. A friend of mine had just ridden the mid-cap tech stock up 60% in 3 months. Clean chart, higher highs, higher lows, every dip bought instantly. And then, the first crack appeared. The price closed under the 200-day moving average for the first time in over a year. That's the signal. The market's way of saying, something has changed. But instead of selling, he told me the same thing I've heard from hundreds of retail traders over the years: it'll bounce back. It always does. That's loss aversion in action, the human brain fighting to avoid locking in pain, even when that pain is small. The next week, the stock dropped another 15%. He doubled down, told himself the story that made it feel safe. Now it's an even better value. By the time he finally sold, he'd erased every dollar of profit, plus another 20% of his starting capital. 3 months of gains. Gone in 3 weeks. And the irony? The exit signal was clear. Mechanical. It had nothing to do with emotion. But he ignored it, because he didn't want to feel wrong. I've seen this play out more times than I can count. The difference between keeping the bulk of a gain and watching it vanish often comes down to whether you act on a quantifiable signal or a story you tell yourself in the heat of the moment. My name is Ben, and welcome to Trading Psychology Wisdom, where trading meets clarity. Here, we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. Because one insight today could change how you trade forever. When I first read Buy Signals, Sell Signals by Steve Burns and Holly Burns, something clicked. I'd been trading for years, but I realized most of my best and worst trades could be traced back to one thing: whether I acted on a clear, quantifiable signal or on emotion. The Burns approach isn't about predicting the market. It's about letting the market tell you when to get in and when to get out. And that's where most traders, including me early on, get it wrong. A few years back, I found myself in what felt like the perfect trade. It was a mid-cap industrial stock, nothing flashy, just steady growth. I'd entered on a breakout over a clean resistance level. Volume was strong. Trend was intact. 2 weeks later, I was up nearly 30%. I had my trailing stop set and my profit target in place. Everything was by the book. Then earnings came out. The numbers were solid, but the market's reaction wasn't. A sharp drop at the open pushed price just below my trailing stop. That should have been it. Exit, protect capital, move on. Instead, I hesitated. I told myself, it's just post-earnings noise. The fundamentals haven't changed. I even pulled up articles that confirm my bias. Analysts saying the sell-off was an overreaction. That's confirmation bias. Finding evidence to support the decision you already want to make. Over the next 5 sessions, the stock dropped another 20%. By the time I finally sold, I had given back the bulk of my profit, plus a small loss. What stung wasn't just the money. It was knowing my system had worked perfectly, and I'd overruled it. Looking back, it wasn't about the chart or the fundamentals. It was about ego. I didn't want to admit my trade was done. I wanted to be right more than I wanted to be profitable. That was the turning point where I committed, no matter what, to following my signals exactly as planned. Because once you start making exceptions, the system stops working for you. So today, we're going to talk about the real difference between traders who keep their gains and traders who watch them vanish. It's not luck. It's not even about having the perfect entry. It's about whether you act on clear, quantifiable buy and sell signals or let emotions run the show. This isn't financial advice. It's just what I've learned through experience, mistakes, and watching countless traders over the years. Signals are the guardrails of trading. When you're cruising along in a bull market, you barely notice them. They're just there in the background. Quiet, steady. But the moment the road turns icy, those guardrails are the only thing between you and a 1,000-foot drop. Ignore them, and you're driving blind on a cliff road at night. Every curve feels like guesswork. Follow them, and even when you hit rough terrain, you can stay in control. The best traders I know don't try to predict every turn. They focus on building guardrails, and trusting them completely when the road gets dangerous. One of the most powerful ideas I took from buy signals, sell signals is simple. Emotions are terrible trading signals. Steve Burns puts it bluntly. Pride, hope, and fear will wreck you faster than any market crash. I've seen it firsthand. In average traders I've worked with, and in my own account. Pride keeps you holding a loser because you can't admit you were wrong. Hope convinces you to buy a falling stock because it can't go any lower. Fear makes you grab a tiny profit the moment it appears, killing your chance for big wins. Here's the problem. When you act on emotion, you're basing your decisions on an internal signal, what you feel in that moment, instead of an external signal grounded in price action. And your brain isn't wired to get this right. There's a study out of MIT that tracked traders' physiological responses in volatile markets. The more their heart rates spiked, the more likely they were to exit trades too early or double down recklessly. The researchers found that elevated stress responses correlated with a 23% drop in decision accuracy. Think about that. Almost a quarter of your trading decisions could be worse purely because of a biological reaction. I remember one trader, I'll call him Chris. Chris had a rock-solid system. It signaled him into a breakout on a mid-cap growth stock. His target was 20% higher, and his stop was 8% lower. 2 days in, the stock dipped 3%. Fear took over. He bailed, locking in a tiny loss. Over the next 3 weeks, that same stock climbed 26% from his original entry. The signal was right, but his emotions stole the trade. This is why Burns's advice hit me so hard. The first step to making a quantum leap in profitability is to stop buying or selling anything without a solid, quantifiable, external reason for doing so. Your chart doesn't care how you feel. Your moving averages don't care about the news headline you just read, and the market certainly doesn't care about the story you're telling yourself. When you start basing your trades only on external, proven signals and refuse to override them with gut feelings, everything changes. It's not that the emotions go away. It's that you stop letting them drive the car. Early in my career, I thought the goal was to predict the market. I'd spend hours poring over news headlines, trying to anticipate the next big move. The reality? I was wrong more often than I was right. What finally changed everything was realizing prediction isn't the point. Preparation is. Steve Burns makes a simple but profound observation. Trying to guess what will happen next is a waste of time and energy. The better approach is to react to what the market is actually doing, using a predefined set of rules. One of the clearest examples? The 200-day simple moving average. When the S&P 500 closes below it, Burns points out that your downside risk increases dramatically. Backtests over 15 years show that simply going to cash when that line is lost can cut drawdowns by about 50%. It doesn't magically boost returns, but it keeps you in the game. I learned this lesson the hard way. Years ago, I ignored that exact rule on a broad market technology ETF. The signal told me to step aside. Instead, I told myself, it's an overreaction. It'll recover. It didn't. Over the next 2 months, my position was down 18%. I finally sold, and of course, the market bottomed the next week. The irony? Following the rule would have meant I sat in cash during that slide and had capital ready when the uptrend resumed. There's a reason professional pilots use checklists, even on clear, sunny days. It's not because they can't remember the steps. It's because when the pressure's on, your brain will convince you to skip the one thing that could save you. That's what a systematic trading plan does. It removes the guesswork. It replaces I think with, if X happens, I do Y. The best traders I know build those rules in advance, and then follow them without exception. No bargaining. No, just this once. Because when you stop trying to predict the market, and instead build a process to react to it, you stop being the gambler at the table. You start being the house. If I had to boil down risk control to one thing, it wouldn't be stop losses. It wouldn't be hedging. It would be position sizing. Steve Burns makes it clear your position size is your first line of defense. Stop losses are the insurance policy. But if you're trading too big in the first place, that insurance won't save you. Here's why this matters. Let's say you risk 10% of your account on a single trade. It only takes 10 losing trades in a row to wipe you out completely. But risk just 1% per trade, and that same losing streak barely dents your capital. That's not theory, that's math. Burns often points to the simplicity of the 1% rule. Don't risk more than 1% of your trading capital on any single losing trade. You survive for losing streaks. you live to fight another day. I remember working with a trader, I'll call her Dana. She had a great system, good signals, solid entries. But she kept blowing up because she'd go all in on what she thought was a sure thing. She wasn't losing because her entries were bad. She was losing because, when she was wrong, she was dead wrong, and her size made it impossible to recover. We sat down and ran the numbers. At 1% risk per trade, her account could survive even the worst cold streak she'd ever had. At 5% risk per trade, that same streak cut her capital in half. It's easy to overlook this because position sizing isn't exciting. It doesn't feel like making a big call. But it's the foundation everything else sits on. If your size is too big, you can't think clearly. Your stops feel too close. You find yourself hoping instead of planning. The irony? When you size correctly, you can actually follow your system without emotional interference, because you know one bad trade can't ruin you. That's the quiet power of position sizing. It's the seatbelt. You barely notice it when things are going well. But when you hit that inevitable air pocket, it's the only thing keeping you from going through the windshield. Every trader, especially early on, goes hunting for it. That one magic indicator. The perfect setup. The holy grail that works every time. I chased it for years. I thought if I just found the right combination of moving averages, RSI settings, and candlestick patterns, I'd have the market cracked. But Steve Burns makes it clear that search is a complete waste of time. No signal works in all markets at all times. Because markets change. They move from trending to range-bound, from calm to volatile. A breakout strategy can crush it in a bull run and bleed you dry in a choppy sideways market. Mean reversion signals can print money in a range and get you steamrolled in a strong trend. I saw this firsthand with a trader named Alex. He had a simple breakout system: enter on a 20-day high, exit on a 10-day low. It worked beautifully for over a year. Then the market shifted. Volatility spiked. Breakouts failed almost immediately. Instead of adapting, Alex doubled down, same signal, same rules, and gave back half his gains. The problem wasn't the signal. It was the assumption that one tool would work in every environment. Burns's point is this: your edge isn't the indicator itself. It's knowing which tools fit the market you're in right now. When the market's trending, breakouts, momentum signals, pullback buys. When it's range-bound, support and resistance plays, mean reversion setups. When volatility's high, wider stops, smaller size, more selectivity. That's not abandoning your system. It's building adaptability into your system from the start. Think of it like a golfer's bag. You don't play the whole course with a driver. You choose the right club for the shot in front of you. Traders who get this stop obsessing over finding the signal and start focusing on building a toolbox of signals, then matching the tool to the environment. The Holy Grail isn't a magic entry. It's a mindset, knowing your job is to recognize the terrain and pick the right path through it. It's one thing to hear advice from another trader. It's another to see the data. Behavioral finance has been studying this for decades. One study from Terence O'Dean at UC Berkeley tracked over 66,000 brokerage accounts. He found that individual investors consistently underperformed the market by about 3.7% per year, not because their picks were bad, but because their timing was terrible. They sold winners too early and held losers too long. That's pride and loss aversion in action, exactly what we've been talking about. History tells the same story. In the 2000 dot-com bubble, the Nasdaq rose over 400% in 5 years, then lost 78% in just over 2 years. Signals like trailing stops or the 200-day moving average would have pulled traders out long before the worst of it. But most ignored them, convinced the party wasn't over. Or take the 2008 financial crisis. From October 2007 to March 2009, the S&P 500 dropped 57%. Yet traders who used a simple rule, exit when price closed below the 200-day, were out before half that damage was done. It's the same pattern in smaller timeframes too. In volatile intraday markets, data shows that mechanical exit rules outperform discretionary ones because they remove the emotional decision-making. A Cambridge study on day traders found those using automated stop losses reduced average loss size by 42% compared to traders closing positions manually. The lesson is clear. The market rewards those who follow objective, tested signals and punishes those who improvise in the heat of the moment. Signals aren't perfect. They're not supposed to be. They're designed to keep you in the game long enough for your edge to play out. Out of all the traps traders fall into, 3 stand out. 1. Overconfidence. It's the illusion of control, thinking you can read the market better than your system. I've watched traders override their rules after a hot streak, convinced they've evolved past the need for stops. It works until it doesn't. And when it fails hard. 2. Fear-based errors. Fear will have you exiting too early or not entering at all. I've seen traders watch the perfect setup unfold, but freeze, imagining the loss before it even happens. By the time they convince themselves to act, the move is gone. 3. Process versus outcome. Confusion. This is when traders judge their decisions solely by the result. They ignore whether the process was sound. If you break your rules and win, that's not skill, that's luck. And luck is not a strategy. Steve Burns says it best. Your success will depend on your ability to approach the markets in a systematic way, using buy and sell signals that match your beliefs and methodology. The hard truth? Most traders know their signals. They just can't bring themselves to follow them. If you take nothing else from this talk, take these 2 tools and make them part of your trading life. Every trade you take, write down the exact signal that got you in, your planned exit, stop and target, your position size, and, this is the key, what you were feeling before, during and after the trade. Do this for a month and you'll spot patterns fast. You'll see exactly where emotions override your plan, and you'll have proof staring back at you. Before you click buy or sell, run through 3 questions. Is this trade based on a quantifiable signal? Do I have my stop and target defined right now? Is my position size within my risk limits? If you can't answer yes to all 3, you don't take the trade. No exceptions. Steve Burns often compares trading rules to seatbelts. They don't matter until they matter. These 2 tools aren't glamorous. They won't make headlines, but they will keep you in the game when others are blowing up. Because the truth is, most traders don't lose because they lack a good signal. They lose because they can't bring themselves to follow it. So let me ask you, how many times have you stayed in a losing trade because you didn't want to admit you were wrong? How often have you bailed on a winner just because the small gain felt safer than the unknown? When was the last time you followed your plan? Exactly. Even though every part of you wanted to override it. If your answers make you uncomfortable, good. That discomfort is where growth happens. The next time you feel that urge to make an exception, stop. Ask yourself, is this a signal? Or is this my emotion talking? The market doesn't care about your feelings, but your process does if you follow it. If this connected with you, don't just nod along. Do something with it. Write down what you learned today in the comments. Share this video with a friend who might be struggling to follow their own signals. And if you found value here, like, share and subscribe so we can keep building this conversation. Remember, you don't have to trade perfectly. You just have to trade systematically and protect yourself from your own worst impulses. Master your mind. Master the market. Trade with confidence and live with calm.